Hello, welcome to our AI Valuations and M&A webinar. I'm Marcin Majewski, founder and managing partner of Aventis Advisors, and I'm here with Filip. Filip, say hi and introduce yourself.
I'm Filip Drozdo, M&A Director at Aventis Advisor. Nice to see you all.
We're very impressed that you decided to take up some of your precious summer holiday time to listen to us. So I hope we'll deliver some interesting insights into artificial intelligence. As everyone, or most people, we're new to AI space, but we started quite early when experimenting with AI in our own business, even before ChatGPT was announced. So we've been observing it and the impact on M&A and investments for quite a while. And in this webinar, we wanted to share what we've learned so far about the public markets, the private markets, and what we expect for the future for M&A, because not many exits so far, but we expect plenty to come. So we are keen to see these exits come to fruition. So anyway, without further ado, maybe let's jump into the presentation. We have 45 minutes today, so let's see the agenda first. Yes, so we'll talk about AI in the public markets, so listed companies. And we have quite interesting and an interesting spin on what actually is AI, and but more about that from Philip. Then we'll walk you through what we've seen in AI funding most recently, what we are seeing in AI M&A, so the exits, and how you should position yourself as a founder or as an investor in M&A. And then we'll summarize, wrap it up, and we'll stay a couple of minutes to answer any questions that you might have. So feel free to type any questions. We try to make it as interactive as possible, and we'll address them at the end of the video. The video will be also available. We'll post it on our website. We're gonna post it on YouTube also, so do subscribe if you can to our channel. Good. Philip, over to you.
Yeah, so I want to start with public market data, which usually is the best and most comprehensive daily information on what's going on. And we had a very successful indices, for example, on SaaS or IT services, where you can track the sentiment and what's going on in the industry. So for some time, we were thinking about, okay, we want to do something like this in AI. But what is AI on the public markets? We were thinking it's NVIDIA, one of the companies that comes to mind, a couple of other smaller players, but which of the companies are AI companies? So we came up with quite an interesting methodology where we said, let's look at one particular date in the past, which is January 27th, 2025, when DeepSeek was released. And markets crashed that day. NVIDIA was down like 17%, a bunch of other companies down double digit. So we said, okay, so those companies which crashed that day or had a big move, they're probably somehow related to AI ecosystem. So we put together a bunch of this across different industries and said this is our AI index of companies that are exposed to AI in a way. And that's the index values that we came up with. We analyzed here the date of launch of DeepSeek, and we run it since November 2023 when ChatGPT was released, so to say the birth of modern AI. And we can see that the index equal weighted is up 166%, market cap weighted where NVIDIA is like 30% up almost 250%. But the main conclusion is that we are at an all-time high for AI companies, and the sentiment couldn't be better. And to speak a bit more before jumping into bull and bear case about what's in there, inside there's a whole supply chain. So when we looked at January 27th and who suffered that day, it was all across the board, from electricity generation to oil and gas, throughout semiconductor supply chains, through data center, all the hardware which inside. So kind of our upstream AI index includes all of these companies that supply something to this growing AI trend. There will be some LLMs or AI apps, I think, further down the road. For now, they're not publicly listed, so we're working with this, and that's what we're analyzing. And I think it's quite interesting that AI is not only your OpenAI or Anthropic, but also a lot of different companies further down the supply chain. But the question, I think, it's what's next. So where do we go from here? And it's our tradition to make a bull and bear case. So Marcin, if you can start with a bull case, how far can we go up from here?
Yes, I don't know how far, but I'm pleased to be bullish because I genuinely think that we're gonna go very far with this. Whether it's a bubble or not, hard to say. There's a lot of expectations, and there will be more. But I think rightly so, because this will change the society and the way people live substantially, and rebuilding basically the whole world to accommodate AI just takes a lot of money, and someone has to do it, and someone will profit from it. So I think it's just the beginnings of the AI revolution, and we're gonna see much more growth. And because there's so much infrastructure that we need to build to accommodate AI, I think we will have a 5 or 10-year investment boom that will drive valuations to unseen heights. That is my belief. Also because, I mean, not only companies are competing with one another, but also nation states are competing with one another. This is something we haven't seen in prior technology booms, that a lot of the infrastructure and the development will be redundant because will be multiplied across geographies. Everyone wants to have sovereign AI, every nation state. So we will have sovereign AI of the US, of China, of EU countries, of you name it. And therefore, I think that the investment in the grid, in data centers, it's going to be immense. And so long as we haven't built fusion as a source of energy, I think we will still need a ton of such investment because it's just expensive. So I think there's a long way to go for these companies. Philip, what's your take?
Yeah, it was a bit difficult to do here a bear case. A lot of those companies are not hype companies or specs or whatever. Is old economy companies which are around for 100 years, just now benefiting from all the investment, all the capex in AI. I think if I were to make a bear case, I'd say look at the correlation with S&P 500, and if you think the market is overvalued overall in the United States, then any correction in this company is going to suffer. I think we saw it here with tariffs, was quite a big decline for all the companies. So if there is a bear market, another bear market in the US, then those companies going to drop faster than anyone else. And my second point, bear point, would be that now all those companies enjoy very high profitability and high margins, starting from Nvidia, which just prints money in billions. And by laws of economics, this will just be competed away and the total profit pool will decline. Yeah. So as new companies develop the technology, as there's more competition on the market, we'll have earnings decline.
Yeah.
And that's why the stocks may drop, just because there's less value generated in profit, more value given away to consumer or user or business. Mm. But I mean, overall, the sample here is quite diverse. So I think overall we're kind of fairly valued, and I personally don't see a bubble here in AI. I don't know what's your take, Marcin.
No, no. When we look at the broad segment and broad supply chain, I think it's reasonable, and even Nvidia looks to me reasonable.
Yeah,
Um,
with the revenue growth and profitability, it has been delivering so far.
yeah, 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 yeah.
But it's interesting to see it's not only Nvidia. We kind of across these different segments, we looked at who performed the best in the release of ChatGPT, and we took equal weighted index of those different companies and kind of plotted by the biggest total return. And Nvidia is part of chip providers. It's here around overall index because a lot of other semiconductor company were not doing so well. What was interesting for me is everything related to infrastructure, electricity, HVAC, data center construction was actually performing the best. So all those picks and shovels companies, which actually build out the data center, are performing the best. I think it's kind of very telling. It's not maybe software, but software is not listed yet, so we don't know how would OpenAI perform on the market. But so far, kind of traditional companies which are in infra are performing very well. And I think is a big implication for investors that you don't have to chase the next Anthropic or OpenAI, and there are a lot of investment opportunities in the public markets, or probably even more in private markets and suppliers to those listed companies who are fairly valued but could benefit from this growing demand for services, for construction, for equipment.
So, Philip, if you were a founder, would you advise, uh, or if you were to advise the founder, would you advise them to chase unicorns or go into HVAC and go into trades?
I think depending on the rest, but I feel like there are opportunities in HVAC and electricity and some companies, and they are traded at mid-single digit EBITDA multiples.
No, but for to a startup founder, would you advise
Start.
them, yeah, to go into HVAC and work in the field, or would you advise to go into machine learning and building LLMs or AI wrappers?
I think depending on personality, and we're seeing a lot of people going in LLMs and AI, but it's also difficult because you also have to run business there, not only do research. So I'd say to each their own. I think HVAC is not as bad an opportunity as it may seem.
That's a very balanced view. I would
Yes,
say the risk reward trade-off is probably better in more traditional trades than AI, actually. I mean, the outliers will be people who make the most money as founders. They will be in AI, but for a reasonable risk return proportion, I think it's good to go into something more traditional, conservative, because there are many very safe bets you can make in these spaces, and there will be also good exit opportunities in these businesses.
Yeah, if this manufacturing combines with some reshoring in the United States, then
Yeah,
it's a lot of money to be made on manufacturing something which was manufactured abroad before and now brought back and is needed for the
yeah,
data centers.
yeah. I mean, but this is not only the US, same is happening in Europe with the globalization. The supply chains are getting shorter, so mm, local onshore labor and manufacturing will grow probably in all the biggest
Yeah,
economic blocks. So that's super interesting. So we move on to private to funding.
funding. Yeah, funding.
Okay, we're super excited about this because we like when things grow. Although there's a lot of nuance here and a lot that you can read from this. So obviously, I mean, we all know the headlines, the biggest funding rounds ever are in AI. That's common knowledge. But if we look deeper at the structure of funding, we see stuff that is not that obvious. So what we have seen so far is that more and more of the total funding for AI is allocated to the winners. I think we can call them winners already. And fewer funding rounds go to, or the of the capital goes to early stage mm, startups, which shows that this industry is already maturing and it's quite late to the game. This year, I mean, it will be off the charts probably 110 billion already as of June 2025. So we might hit 200 billion this year in AI funding. I wouldn't be surprised. And that does not include all the investments of the Mag 7, for instance, into AI. So I would say probably the investments in AI are already in trillions of dollars. Mm, so it's an exciting time and a lot of money to be made for sure in this space. Mm, in the next slide, we have also the count of these. Similar trend, fewer deals, much more concentrated. So the number of funding rounds peaked in 2021. That was related to COVID also, probably to some extent. Uh, I mean, 2025, we may see a recovery in volume of AI funding rounds. We might match the 2024 record, but I think we will not grow beyond what we've seen in previous years. I think 2021 marked the peak, and I think it will continue to concentrate on the largest startups in this space. So yeah, so that's it about this slide. Um, yeah, valuations. Valuations are super interesting here. This is a snapshot of the valuations in 2025. And we refresh this every now and then. Mm, there is a wide range of valuations, as you can see in the AI space. So EV revenue from high single digit for some companies to more than 100 for Perplexity. Mm, and the biggest input is the revenue growth in these valuations. And this we can see in the next slide where we compare funding rounds for OpenAI and how actually the revenue multiple, EV revenue, contracted as the company grew. So back in December 2023, they raised money at 53 times revenue, but then they grew more than 5 times, and the multiple contracted to 42. Then they more than doubled again, almost tripled, and the multiple contracted even further. So I mean, it's quite natural when an industry matures that that the revenue multiples contract and the companies eventually will be expected to turn a profit. But I think we're still quite far away from that. But I would expect companies to try to monetize more aggressively in this space. And we, I think, can expect an overall big contraction in further contraction in revenue multiples we see also for early stage companies as it becomes just easier to make money as customers become more comfortable with paying for AI, which used to be a novelty and was basically for free, but now a lot of companies are really monetizing it very hard. So in the next slide, yes, we have a few ideas or differentiators. What drives valuation beyond the revenue growth? And this is very important to discern the quality of the underlying business. So under the AI banner, a lot of business can be described. But there are clear companies with more sustainable and more robust business models, and there are companies that are much more risky. So we differentiate them between foundational models, which are companies that basically do AI research and training, and that underlie other people's applications. Then we have AI applications which kind of are robust and built on top of AI. So AI is a big component, but at the same time they solve actual problems typically in a vertical or an industry, but are not only a wrapper on AI. So someone who understands their clients very well, understand their workflows, and leverages AI in new ways, which were not possible before to deliver value to the client. And then lastly, we have what we call thin AI wrappers, which tend to do something that is heavy on compute. They add very little value, but they provide, for instance, a better interface than ChatGPT to do the same thing, which is the riskiest of these business models. So the companies that work on the foundational models, they tend to have the highest valuations. We believe it's justified because they're more sustainable. Then AI applications, we see they're also very highly valued, 10 to 60 times revenue. And currently they're very sales heavy, reliant on pushing clients to adopt them, and quite risky because eventually ChatGPT or someone like that may disrupt them or give it the same functionalities for free. But in general, the closer the fit to the client's actual business case or problem, the better the valuations. And last but not least, generic Me Too business models, they tend to have quite low revenue multiples, 1 to 5 times. This is what we are seeing in the market today. Philip, something to add to this?
A bit everywhere. I think on the slide with top fundraising, it is interesting to say that it kind of relates well with public markets, that all of this funding to OpenAI, Anthropic, Crusoe goes to infrastructure eventually or training the models. So it's not a lot of AI applications that get the funding, but a lot of fundamental research and really capex on data centers and processors that's being funded. And we know a lot about SaaS, and a lot of people know about SaaS valuations. I think here's a good comparison that if you think about 20 or 30 times revenue for some companies which are at the forefront of research, it's not a lot actually. At the peak of SaaS bubble, like a lot of public companies were valued at 20, 30 times revenue,
Yeah.
much smaller growth and and no profitability. We don't know exactly what's the profitability here for AI companies, but kind of on a very high level look, these multiples don't look stretched. So I think the conclusion is that the evaluations here are rather fair, and a lot of investors kind of got to understand how to value and analyze those companies. So it's not like you'll be provided a very big valuation just for being an AI company.
Yes. 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 Yes.
AI M&A?
Yes. AI M&A. We're early to AI M&A because the volume is minuscule, I would say. But then these are very high profile deals. Mm, so we've analyzed the last 2.5 years, how the volume has been developing. And it's still slow, I'd say. We went from 100 deals in 2023. We classified as an AI M&A deal a majority buyout. So just to be clear what we understand here. So we disregard all the funding rounds. So 100 exits in 2023, in 2024, 138. In 2025, we're already at 80, but it's not that it's gonna be it's gonna be a record for sure this year, and it's taking off slowly. But I think the peak in AI M&A is still a few years away from us. So very early innings so far. But I think, and what we've seen and what is quite notable is that the cycle from founding to exit of AI companies, it's quite short. And I think it might get even shorter than that. I mean, we're seeing companies trying to sell their business before even they go to market. Actually, quite a lot of this is happening. So as it gets more competitive and more difficult to grow an AI business, I think the cycle will continue to shrink. So right now, from founding to exit is only 5 years, very young companies. And I think going forward, it will be even shorter. We're seeing companies founded and sold after 6 months right now. So this is something that we haven't seen so far, and it's actually quite amazing, but also difficult for founders to handle because you really have to understand what's going on in the space and time your entry and exit very well. So this game of AI M&A, I think it's only for the best operators, given how tricky it is to get it right. Philip, anything to add?
No, I mean, yeah, I think I agree. The M&A and AI will continue to grow. It's really difficult so far to understand which company is AI, which company is not AI, which is
Yeah.
just pivoted and became AI, and it's really just a SaaS with a bit of AI functionality. But I think, as you said, more and more companies which are started will be acquired rather fast.
Yeah. Good. So we asked ourselves a question: how to value, and we often have to answer our clients how to value their AI company. So we wanted to share our real life experiences and give you some hints into how to value an AI business specifically in an M&A context. And so first of all, what is important to note is that the hype around M&A and the fact that there are so many huge deals at very high valuations, it really distorts the picture. And the press coverage you get, or wherever you get your deal news, doesn't show the whole pictures. Mm, so there indeed are a few very high profile deals where well-funded companies buy other usually well-funded companies for synergies and for talent acquisition. And then valuations are really huge, mm, and usually justified because the potential for the incumbents is proportional to the money that they pay, and the risk also, for instance, to Meta, if they don't win this race, the downside risk is huge. So to protect themselves, they have to pay up. However, when we look at most companies that comprise the today's cohorts of AI companies, we're seeing that a lot of them are struggling. They struggle to find product market fit. Uh, they have huge churn. They have huge expenses also because they basically resell other companies' computing power. So unlike previous SaaS companies, they actually have very low gross margins. Mm, it was typical in SaaS businesses to have 90%, 80% gross margins. Now we're seeing 40, 50% gross margins. That's very hard to build a sustainable business model with uh, with such economics. And on top of that, I mean, it's very easy to build a business with the help of AI. But the next cohort will have it even easier because each generation of AI companies builds tools for the next generation of AI companies that make it even easier to scale, acquire business. So I think we will have soon hyper competition in a lot of these spaces, which tends to drive low, margins low, and customer acquisition costs high. So that will be deadly to a lot of AI companies, unfortunately. Um, and lastly, what we are seeing, and that's evidenced by what's happening in the AI in our AI index, is that a lot of the value goes to the infrastructure layer. So actually, the physical infrastructure, the people who are building the energy that goes into fueling compute, and of course, from looking at the private funding, the model developers, the LLMs. Mm, and I think application layer, where I think the most of the activity goes, gonna be very difficult. So if I were to choose, I would definitely pick picks and shovels over fighting where everyone tries to fight in the AI application space. Mm, so that's the background. Um, and I think, I mean, we try to be boring a little bit in our approach and what we kind of how we educate our clients. Mm, so we think that AI companies aren't really inherently different from other types of businesses. And the same rules, the same playbook for valuing AI companies still apply. So you have to do your thorough fundamental analysis. You have to understand the unit economics. And the main drivers we're seeing are the same that we're seeing in SaaS. So revenue growth, client retention, customer acquisition, cost to LTV, etc. And I don't think we see any premium for being AI. If anything, I mean, I think exits right now, unless they're driven by the buyer and the synergy, are kind of a red flag, to be honest. If someone is giving up, when the market is booming, that's usually a red flag. If someone is proactively seeking an exit, it's a different story when you get approached. I think there's no better time than now if you have the right approach to respond positively and seek an acquisition. But proactively seeking an acquisition probably is very difficult and has to be very well prepared if you want to be successful in this environment. And so just to recap, in the next slide we have our typical boring playbook how to value a tech company. Mm, so to all of you, to many of you, probably it's familiar. There are income-based approaches, market-based approaches, and asset-based. Mm, income is basically discounted cash flow. So you project the business forward the next few years and try to estimate and value the cash flows that it will generate. Super hard in the AI space when most companies don't make money. And so very speculative, but doable. Market based, I think we've been quite thorough in understanding and presenting valuations on the funding side. Not many benchmarks on the exit side, to be honest. But if we were to give some indication, you should have essentially the multiples you see on the on the funding side, and exits would probably be fairly priced if they're half of the funding round. In other words, if you raise money today at say 10x revenue and you want to make your investors whole, the business should double and then you can be comfortable with that the exit will happen at 5 times but double the revenue. So that's the margin of error I think you should be prepared to have in order to responsibly take on external funding and be confident that it's non-dilutive, that you're not destroying value to the shareholders. And last but not least, we're seeing and we're discussing often asset-based approach on replacement value approaches, which are typical to industrial companies. But I think a lot of founders, they would like to steer dialogue in these AI conversations in the kind of replacement value of their technology. We're not that keen on this, and we don't really believe in this because in this approach, because AI technology tends to depreciate extremely quickly because the cycle of all the tools that you use in developing AI businesses is very short. Constantly someone's coming up with something new. So anything you build tends to become obsolete quite quickly. So yeah, so that's it when it comes to valuations. As I said, we try to be conservative, realistic, and make sense of what's going on in today's AI landscape. Philip, if you have nothing to add, I think we can wrap up.
Yeah, I think we can.
So that's for this section. Yes, we generated a meme with AI. That's the only thing I think we generated with AI in this deck. I think there's so much hype and so much FOMO in this space that we would like to bring some common sense and transparency into what's happening. Um, so please feel free to reach out to us if you have any questions and if you would like some advice on what to do with your investments, with your exit strategy, and we'll be happy to give you our advice, reasonable balanced advice. Mm, so yeah, so that's it. M&A is gonna happen eventually. So you have to be quite deliberate and take go about it with some common sense. Cool. So we have a bunch of questions. Shall we address them,
Yeah,
Philip?
yeah. I mean, the
Okay.
first one I see is could take all our time, but I think it's what's on the mind of a lot of people. So is AI another dot-com bubble?
Yeah. There are a lot of similarities, uh, but I think it's different in the sense that companies are really making money on AI, or at least generating revenue, which is different from the dot-com bubble, when you could have a business without any revenue, and that would be valued based on eyeballs. Today, not so much. I mean, you have to sell a bunch of tokens at least to get some valuation. Mm, so yeah, so that's my take. Philip, second, is the hype slightly dying out?
I think yes. I think that's true that hype is slightly dying out. I think a lot of investors now are much better informed on AI. And as you said, they value companies based on fundamentals and financials and not technology or just being AI.
Yeah,
And now companies have to answer just much more difficult questions about how many users they have, how will they earn money, what's the gross
yeah,
margin, and so on and so forth. So it's more difficult to get funded. And a lot probably got burned on startups where there's an initial wave of customers and it's interesting and it's new, but then ChatGPT adds this functionality, it goes to Copilot, it goes to Google Gemini, like Google is rolling out hundreds of products, yeah,
yeah,
every conference, let's say. So you really need to make sure this AI application you're funding in seed or Series A will survive. Something like there was a wave of AI note takers. Now that's in Google Meet. There are some things that help in Excel. Now Google Sheets has equals AI function and it directly
yeah,
prompts Gemini. It's just, you know, as I think as is shown in fundraising, there will be big winners from this, and it's likely big companies with big budgets, and it's going to be much
yeah,
more difficult for smaller companies.
yeah, yeah. I mean, I think investors are becoming more discerning, and you don't just get their attention by being an AI company. You really have to have a good team and a good go-to-market strategy in order to attract funding. Okay, good. We have another question. What was the other part in the funding? That was usually later stage funding, so DEF or later. So
So corporate venture rounds like
yeah,
opening has with SoftBank,
yeah,
for example.
yeah. Okay, another question. Do you think foundational models will be commoditized? That is a good question. I don't think we're experts in that. I think there's much more to foundational models than just the model itself, because it just takes a lot of energy and hardware to create them and run them, manage them. And um, and I think there's just going to be a handful of companies that can afford to maintain them. So I think we'll have an oligopoly where a few big companies make a ton of money. Mm, I don't think it's going to be a commodity eventually, just because it's just so rare, so to develop, so expensive. But I know we're not engineers, so we cannot. answer that. Okay. Do you see multiples derived from fundraising versus public companies are as being equally useful? Many times the fundraise comps have much higher multiples. Yes, this is a very good question. So, and therefore, different companies are different at different development stages. Uh, so, funding rounds they tend to be at higher multiples because of the higher growth rate. Whereas the public comps they are lower because these are already mature companies. Now, they will probably converge as because private companies stay private for longer. So we will see probably very large rounds at very late stages for OpenAI, where the multiple is really close to what we see for I don't know, Google, for instance, or Microsoft.
Yeah,
So so yeah,
I think we use also a lot kind of to set a ceiling on expectations or understanding where kind of ballpark multiples are. So, for example, if if OpenAI or Anthropic raise at 20 times revenue and they
yeah,
grow, let's say X%, then a smaller company for niche application kind of there will be nowhere close to 20 times if the leading players are raising at that time. So that kind of sets the ballpark expectations for the multiple.
yeah. Oh, I see a very good question here. Do you have any views on how big the losses need to be in the big AI companies before serious questions about survival are raised? Philip, what's your take?
That's a very good question. And
Yeah,
we've seen a lot of SaaS companies in the history survive for a very long time. Same with marketplaces. So I was always skeptical about the losses and said that, it's not possible. Some companies are loss making, they never turn profit. But then we've seen Amazon, we've seen Uber, we've seen Airbnb. Those are
yeah,
different business models, but kind of raise the same question. So I think if they they get big enough, those companies, and it's not a problem. For smaller companies, of course, they may die out, but top LLMs, I think they can continue to run with losses for quite some time, unless there is a significant drop in growth rate. And I think that's what we've seen in SaaS industry. As long as you're growing, no one asks any questions. So
mm,
if you're not growing, then the first question is, where is the profit?
yeah.
Whether you can turn it on. Some companies like Uber manage to do it, so I think it's possible.
My view on this is that so long as interest rates and cost of capital are relatively low, no one minds that these companies are loss making. So long as there is reasonable growth, of course. Mhm. But if we have another bout of inflation and in turn interest rates go up, so that basically we would need to have a serious economic crisis. I think that will lead to a big slash in spend on AI, among others. So it's quite a substantial probability, but so long as the environment, the financial environment, the interest rate environment is as it is, I don't think it's realistic to expect that. Mm, good. What else can we talk about? What AI tools do we use, Philip, as an M&A advisors? We use quite a lot, actually. Uh, we use a lot ChatGPT, and we're trying to embed it into our workflows. We use Gemini more and more. I think it's kind of entering our workflows more and more. Sometimes we supplement it with Claude.
We did use Perplexity for some time, but now after ChatGPT released its search, I think it became a bit redundant
Yeah.
to have a separate product for search. We try different tools. I think it's a lot of them are not on the level yet, and I think it's a kind of good connection with AI companies that are growing fast because a lot of people want to test it.
Yeah.
So if a company approaches us that we have an AI tool for M&A, we're quite likely to talk to them and to try it out, but in the end, it doesn't work. So it's
Yeah.
easy in AI, I think, to get initial traction, but to retain customers, it's much more difficult.
But what I have concluded is that as in any professional services firm, we need to turn into a technology firm. So we will be investing heavily to build our own agents and AI systems. And eventually, I think especially the junior analyst work is changing. Because what me or you, what we do is, which is mainly talking to people and communicating and advising people, is not changing that much. But gathering data and analyzing data, this is undergoing rapid change. Cool. Another question from Mark that is very good. Do you find the rule of 40 metric to be useful in the AI space? I mean, I think it's an interesting concept, and I think it's still relevant to take this into account. So the sum, just to remind everyone, the rule of 40 is sum of profit margin plus growth rate in revenue. Although a lot of AI companies, they tend not to be profitable. But of course, I mean, investors look at both. So if you're an AI company and you're both profitable and growing, then that's a recipe for a great exit, usually.
I think it depends on retention because rule of 40 metric was kind of invented for SaaS companies to explain why they're not profitable.
Yeah.
And they would be not profitable because they have a big customer acquisition cost and subscription revenue over time. So it paid off to invest in growth and be not profitable. So if an AI company is having similar financial profiles, that by investing now a lot
Yeah. Yeah.
makes sense. But if it's closer to e-commerce or just reselling of models, then you need to be profitable right away. Otherwise, you're just kind of burning cash, and the customers are lost in a couple of months or a year, and there's no money to be generated in the future.
Yeah. New questions keep coming in, so let's we can extend it, and I guess until hour.
I can take the last one on how AI valuations impact,
please.
because we were just discussing this just before the webinar, that while we're looking at the DeepSeek effect in January 27th, and which companies benefited from it, their stock prices grew, and which companies declined. And we were thinking, okay, but where are all the SaaS companies, and why they're not big winners from potential decrease in AI prices, or why they're not big losers? And they actually didn't move so much that day. So I think those are kind of two separate categories, everything which is related to AI and related to SaaS.
Yeah.
And I think investors also understand this, and despite SaaS companies, mentioning AI 20, 30 times, who has more mentions of AI in the earnings call, I don't see I don't think public market investors are buying this, and they're a separate class, SaaS companies, and AI will be a separate class.
Another question I see is quite interesting. How do you view the applications in the voice and video space being disrupted by Google? And I think this is we can generalize it a bit more, how Google is disrupting a lot of business models. And it happens with video, with Google's AI video generating capabilities. It's happening with transcripts of calls, for instance, in Google Meet. I think what used to be a threat to a SaaS company, but for most companies was negligible because Google wouldn't bother about rare, small use cases. I think with AI is a material and substantial threat. So it's quite scary to me how quickly Google this time around is catching up. It's I think they were very slow, for instance, to get on the bandwagon with social media, and it was a failed attempt. But I think they learned the lesson, and they're doing really great with this AI race. I mean, but they also were first or one of the first to invest in it, so they have an advantage.
Yeah, and I think we had a good sentence. I don't know if it's in the final deck or not. That the bigger the TAM, the riskier it is.
Yeah. Good. One last question, Phoebe, maybe we take. Is ARR an outdated metric in the AR world? If so, what should replace ARR?
I think depending on the business model of the company, if it's a subscription, then it's not an outdated metric. If you can still run the same analysis on number of customers, ARPU, LTV, CAC, and all of that, it's okay. You can use. I think it really depends on the business model. If it's something completely different, like you're reselling tokens or it's one-off purchases, then I wouldn't use Arrow.
I mean, ultimately, whatever metric you use, we try to resort to DCF as possible. So ultimately, the equations have to add up, and at the end of the day, there has to be some EBITDA. So ARR is just kind of a shortcut to get to a conclusion quickly, and a tool we use, one of our tools in our belt, but it's never the only thing that you use to assess a company. Good. So I think we've come to an end of today's webinar. If you'd like to speak with us, or you're interested to get to build your AI strategy, exit strategy, or investment strategy, evaluate some opportunities that you have, feel free to get in touch with us. We'll be happy to take your calls and advise you. So we're there if you'd like to discuss. We hope you like this webinar. Please share with your friends, colleagues, family, if you think that this is relevant to them. The recording we will distribute to all of you, and a transcript also. So thank you very much. Thanks again for taking the time out of your holiday schedules. At least in Europe, it's a holiday month. Maybe not in the US so much, but anyway, we appreciate your attention today.
Thanks everyone. Have a good rest of your day.
Thank you.
Thanks. Bye-bye.
Bye bye.